Hey everybody, welcome in. Today we have a very interesting topic. It's a very relevant topic for all of you in crypto and in this very volatile stock market. And the title is probably not the most exciting, but it's all about stock and crypto position sizing. So what do you do when you're in a situation like me and you made some bets on some things like Ethereum and Bitcoin and Tesla and MicroStrategy, and they have exploded and you're using leverage positions and things are out of control? And that's kind of what this topic is all about. So even today, just looking at Ethereum, I always had a policy of having 15%. I started with 15% Ethereum, 85% Bitcoin, then added a little bit of Cardano, and now my Ethereum position is nearly 35%. So because it's just growing so fast and my cost basis is so low. So again, this is all about resizing and how we manage that going forward. So thank you for being there. Again, this channel is about math, money, and freedom, so we can give back to society and make the world a better place. Disclaimer, of course, none of this is investment advice. This is just food for thought. So make sure you all think along lines of safety and risk management as we live through this transformative time. Okay, first slide. Position sizes. Should we have big ones or small ones? And that is the literally million-dollar question. So first of all, a couple of things to think about. One, risks. If you are in too large a position and that stock blows up, you can be in trouble. The second thing to think about is sometimes if your position is too small, imagine you just bought one share of Tesla instead of 100. You miss out. And the third way to think about things as well is, one of my favorites is what I call the opportunity cost. Imagine you're locked into a position. You're locked into crappy mutual funds or some type of pension allocations that are given to you and mandated by a company, and you can't jump on the Bitcoin train. That can be heartbreaking, and that's also a risk. So I want you to think in terms of those three different items that I just ran through. But let's go deeper. So let's first of all start with a couple of fallacies out there. A lot of people, believe it or not, there's this thing called what I call the 100 share fallacy. I don't even know if it's an actual term, but I know very smart individuals and they say, well, I'm not buying Tesla at $200 because I don't have $20,000 and I need to buy 100 shares of whatever I buy. I'd rather buy something that's a $10 stock. This type of mistaken idea costs people a lot of money. There's people that prefer buying $10 stocks and $20 stocks because they like to think they have 100 shares. Now, if you're trading options, yes, you need at least 100 shares to be able to sell a call against them, but that's a separate issue. Most people just buy stocks, but they think cheaper stocks are better, and they're not. So I'm going to show you guys a couple of things. Most expensive stocks. This is a list of stocks that are $300 and above. Okay, we got, of course, in cryptos, Bitcoin, Amazon, Ethereum, Google, gold. Oh, gold is in there. Whoops. Shopify, MicroStrategy, Tesla, Trading Desk, Nvidia, Netflix, Illumina, Binance, and Twilio. Again, I just stat ranked my list of stocks that I look at every day. And look at these. Now, what do they all have in common? They're expensive, but they're all really good and they all outperform everything else with the exception of gold. So that's so I said, whoops, how did that sneak in there? Now, in terms of statistics, on average, quarterly returns of stocks more than $300 in value have a 50% chance of returning more than 6.4% per quarter over the last 10 years. Think about that. Imagine having a stock over $300. You're 50% guaranteed that will return at least 6% per quarter. And think about that in terms of compound annual growth rate. That's huge. Again, expensive stocks are expensive for a reason, but don't not buy them because you think they're too expensive and you'd rather buy a $20 or $10 stock. It's better to have one share of a $2,000 stock that's going to give you 6% per quarter than 100 shares of a $20 stock. So just a little bit of food for thought. Again, position sizing. So where's the beef? As usual, sorry to all the vegans out there. It's a turn of phrase. And let's talk about U.S. families. Now, I'm just taking the U.S. family asset allocation as an example, but I'm sure there's similar types of data that you can tweak for your own jurisdictions, whether it's Australia, the United Kingdom, or India, or Colombia, wherever you may be. So the real idea behind this, again, is just to get your heads in terms of the frame of mind about how you need to grow your net worth over time based on your age. Now, there's two things here. There's a median net worth and average net worth. I'm ignoring the average because that's skewed because of billionaires. But the median net worth is typically what we need to focus on. So if you're less than 35, people are just starting out and they're just beginning to accumulate wealth. 35 to 44, median net worth is about 90,000, call it 100,000. 45 to 54, 168, etc., etc. 55, 212, 65, 266, 75 plus 254. You can see that net worth actually decreases as people retire because they start eating into their funds. But it doesn't actually decrease that much, which I found very interesting. So again, I just want you to think in terms of how much you expect to grow and have over time. Now, the other thing that I've done is put together a typical family average asset allocation by age group. And again, this is just hypothetical. This is not investment advice. This is just the way I think people should think about ballpark how they should structure their assets. So as you get older, you need to reduce risk. That's why I've got stocks and Bitcoin and crypto should go lower as the older you get because they are riskier and you need safer bets. Now, because of the situation in the bond market and negative yields, etc., I didn't include any bonds. And then in terms of real estate, this is another example. When you're 25, you typically don't own a house, but you start buying real estate and that becomes a big part of your net worth as you go forward. And then, of course, cash. Obviously, cash is trash, doesn't return anything, but at some stages, it's important to have it. So, for example, young people, 25, need to start saving some cash so they can ultimately buy a house, which will become one of the top assets over time as they go forward. So you can see approximate ratios that I've put in for different age groups of how much cash you have, because I want you to start thinking in terms of the buckets. Now, let's go a little bit deeper into this asset allocation by age group of how much you'd approximately need. So for example, if you're 45, your stocks and Bitcoin should be worth on average about $92,000. Your real estate about $67,000 and cash on hand about $8,400, just based on that example. And the reason that's important is for the next step. So one of the points I want to get across is risk and time. You can see here from that example, it took 23 years for a 45-year-old to save up $168,000, so approximately $7,300 per year. Of course, it's not exactly that because of compounding, etc., but just to think, now, if you have your stock portfolio and you lose 30% of your stock portfolio in a year, it'll take you 4 years to recover. So you won't actually get back to square one until you're like 49 years of age. So the point here I'm trying to make is there's a reason to manage risk and there's a reason to size your assets across different allocation types because time in the market is important. You get wiped out, you lose 30% of your portfolio, you'll be paying that price for 4 years. And the difference between 49 and 45 is a big chunk of time. So also the advantage for the younger generation, and there's so many people, I've got 14 and 15 and 16-year-olds who are investing in crypto and they're doing really well. But it's incredible to think, I didn't buy my first stock till I was in my 20s, but these young kids are getting schooled so young and in the market so young. It's incredible. So very excited for them. But it's also important. Time in the market is key, but don't lose everything you have. But it's also good to make your mistakes when you're young, as I mentioned in a previous video. So rule number one, there's going to be a lot of rules here, and these are things that I've learned over time. It's important to think in terms of buckets, or I like to do things in thirds. So if you imagine your net worth in thirds, you will have, say, a third, it could be your stocks, and a third will be your real estate, and a third will be things like cash and pension. So of the third you have in stocks, you break that down into a further third. So you'd have your high beta stocks, which are high risk stocks, and your crypto, maybe 1/3. You'd have your ETFs, your ARK Invest, and mutual funds being the 2 other thirds. So you can see here, the important message to get across is you've got your life net worth, which could be real estate and pension and mutual funds and 401ks and IRAs and ISAs and whatever you have in your jurisdictions. And then 1/3 of that net worth can be invested in stocks, let's call it. And then the second third, you break into thirds in between very safe stuff, etc. And that's the point I want you to all get across. Now, these thirds, they could be 40, 30, 30, or 40, 40, 20, depending on where you are, your stage in life, as I showed you in the previous slide. So think about that carefully as well. Now, the most important thing to take away here, just to highlight, imagine you've got $300,000 in net worth. You could have approximately $100,000 real estate, $100,000 in cash and pension and 401ks, ISAs. You'd have, and the third would be 100,000 in stocks. And of that 100,000 in stocks, you'd have 33,000 in high beta stocks and crypto, blue chip crypto mind, things like Ethereum and Bitcoin, not Dogecoin, although Dogecoin is completely on fire right now. Just shows you the crazy time which we're living in. And 11% would be your total net worth, would be in those 33K high beta stocks. So just think in terms of those dimensions. Don't put 100% of your net worth on Dogecoin. That's the message here, ever. In fact, rule number 2, asset allocation rules. Never put more than 1 to 5% of your portfolio in any asset. And also remember, position size should be proportionate to expected outcome. So if you have something like an asymmetric bet, like Bitcoin, and you could get it at $9,000, and you know it's going to $100,000, it's okay to be a little more greedy. Again, nothing is certain in life. There's always a 1% chance or less that Bitcoin will fail. But at the same time, just keep that in consideration. Think in terms of outcome as to how much you actually allocate. Now, a simple example of that is, again, going back to your $300,000 portfolio size, $100,000 in high-risk stocks and crypto, you should have no more than 2% per trade or position. Now, if it's an asymmetric bet like Bitcoin, that can, of course, be higher. And it's also important to think in terms of stop loss. I'll talk more about that afterwards as well. So if you think in terms of your trade position of $2,000 being 2% of your $100,000, which is a third of your portfolio, your stop loss would be 20%, for example, under your position. So your total risk should be about $400. Now, in terms of number 3, stop losses, we touched on them briefly there. Make sure you do not suffer more than a 25% drawdown in any position. So imagine you buy Bitcoin at $100,000. Be prepared to get out at $75,000. Use trailing stop losses to lock in gains. But again, although I gave that example of stop losses, do not use stop losses on crypto because you'll be wicked out. Instead, it's better to use it when you're actually looking at the market, and then just be prepared if you see it falling, and be prepared to get out if something does happen. Again, that's critical to risk management. Number 3, use options to manage risk. So for example, I love selling calls against positions after they run. Very, very important. Or another way to use options could be to buy a stock cheap by selling a put to get it put to you. Oftentimes, if you pick a good stock, you never get put the stock. You just get to keep the premium. But that's another example of how you can play the game. And we work a lot on options and option strategies within Patreon as well. Risk management number 5 is cut your losses. Don't get married to a losing position. Don't hold on and hope for it to come back. You buy something at $100, it goes to 50 and then 40, and then you're still holding because you wanted to get back to 100 because you don't want to admit the loss. Don't do that. Be disciplined, be strict. There's going to be big downdrafts for big names coming when we get into the crypto winter, so be prepared for that. It could also be a market crash. Again, don't get married to losers. The other thing, number 6, is know your timeframes. This is very important. So in the Bitcoin world, for example, it runs in epochs, 4-year cycles. And we are at the beginning or about a third of the way through the bull cycle right now. So just keep that in the back of your heads all the time as well. I'll be doing an upcoming video on exits, so just watch for that. Number 7, rebalance. Now this is a very important one. Again, I'm hammering it home with that position sizing. You got your portfolio size of $300,000. You got 100,000 high risk stocks. Your position that you bought for $2,000 has now gone to $10,000. You have a big $8,000 gain. So what do? And this is the problem we all face right now, me included. And I'll talk about what we can do with that. One of the safest things to do, and it'll be covered in my exit video, is take your money off the table and let the table's money run, or reallocate. Take all your profits or a chunk of them and invest in safer assets or different assets that have different expected outcomes. So very important, number 7. And warning, of course, I'm going to show you one thing here. This is how a portfolio can get completely out of whack. So just imagine this is a hypothetical April 1st. And it's sort of hypothetical, but sort of not. It doesn't include all my positions, but it includes some of the big positions. So I was in a very big cash position right before the pandemic hit, because I was expecting a different type of crisis, not a global pandemic, but I had a feeling something was going to go wrong. And now when the pandemic hit, I ditched the mutual funds. These mutual funds were in 401k and ISA type IRA accounts. And the cash I put to work immediately, and I got positions in certain names like Tesla and Square, etc. I felt very bullish in these names. And what you can see here, the important thing is I was 80% in cash and mutual funds in March. And a year later, April 1st, I moved to 7% cash and mutual funds, just because the sheer growth in things like Bitcoin and Ethereum and Tesla has just been completely out of control. So just want to leave that with you all and just show you exactly how very quickly a portfolio can get completely out of whack. In other news, and you guys have heard me talk about this before, diversification is very important, but why diversification is only required when investors don't understand what they're doing. And what I mean by this is, if you buy 100 stocks or 200 stocks, you're just going to replicate what the market does. You might get 6-7% on average per year, and that's not going to help you crush it. Instead, it's good to weed out the losers and the mediocre players and try identify the winners. And that's kind of the name of the game. But again, some diversification is always important, because if you have, say, 10 stocks, one blows up, you got a 10% position on that, you lose 10%. So always beware of that as well. Now, in terms of Berkshire Hathaway, what's really interesting is when you analyze their last year, and if you look at Apple making up 49% of Berkshire's total portfolio, you can see that means 51% of his portfolio fell 68% last year, because Apple went up 68% and the stock is a net flat over the year. So Warren Buffett is breaking the rule of diversification, because half of his holdings is Apple. That's crazy for a professional fund manager. Anyhow, enough of that. Conclusions. Thank you for being here. I know it's a long one, but it's a very, very important topic that we all need to embrace. First of all, it's a transformational time. This is the biggest asymmetric bet that I have ever seen in my lifetime. And we're still in it, and many people say we are still early. Backing winners is key. Don't back losers, back winners. Spend a lot of time looking for those winning companies. And that's what I spend a huge amount of my time doing, to try to find exactly who's going to change the game for the next 3 to 5 years and get a part of them early, not late. Don't buy them after they've run 800%. Try to get in early. Number 3, pick the top. So tops come, things top out, and I like to do 2 things very well. Pick bottoms and pick tops. And I can manage risk but with both accordingly. And for those of you in Patreon, you know what I do and how I do it. So that's very, very important as well. Have a mix of assets. Have some stocks. Have some real estate. Have some cash for that rainy day. Some safe ETF funds and some pension funds and stuff. And of course, for this transformational time, everybody needs to have a little bit of crypto. So think in terms of that mix of assets and allocate carefully. Don't have all your eggs in one basket or one coin, for example. Very, very dangerous. And even the pros break the rules. As I mentioned, people always talk about any book you read on investing, it's all about diversification. For even Warren Buffett, 49% Apple, that's not diversification. So again, find the winners and back the winners. And finally, this is kind of a shirt that I thought was really cool. Irresponsibly Long. It's from Raoul Pal. And sometimes it's not bad to be too big in one position, such as Bitcoin. So just want to plant those seeds with you. Next up, how to plan your exits. So if you like this type of stuff, please subscribe to the channel and watch for scammers. I hired a new service to eliminate all the scammers in the comments. So let me know if your comment doesn't show or we're not engaging with you in the comments, because I don't want them blocking too many comments. And but at least they'll dramatically reduce the amount of scammers out there, because it breaks my heart when people are scammed and tricked out of their hard-earned money. So love you all. Thanks for everything. Take care. Bye.